And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, the whole enchilada. It's the Lance Roberts Show, presented by Clarity Financial. It's life, money, and sweat equity. Now, welcome in to the Lance Roberts Show.
And welcome to the Lance Roberts Show podcast right here at realinvestmentadvice.com. Of course, get by our YouTube channel, Lance Roberts Show, and subscribe to our channel. You can get our updated video cast every single day. Of course, we at 3 o'clock, we wrap things up for you, tell you what happened in the day. And of course, always kind of go through some of the bigger picture items when it comes to managing money and what's happening around the world. Today, we have two special guests, one in studio, one on the phone. We have Michael Lebowitz, CFA, joining us today live from his undisclosed bunker, along with everybody else today, I think. And then coming up in just a minute, we'll have the lovely Danielle DiMartino-Booth, who's the president of MoneyStrong. She also writes the Daily Feather. She will be here in about 15 minutes. We're going to talk a little bit about Fed. We're going to talk policy. We're going to talk interest rates. We're going to talk Trump. We're going to talk markets. So, and speaking of that, another down day in the markets today, of course, the last couple of days, pretty big rout. Got investors kind of, very concerned here. We wrote a technically speaking post today, updating our Tuesday analysis. We're deeply, deeply oversold. And we should, the expectation is not to panic. As investors, we never want to panic. We don't want to panic sell. Yes, the markets are down over a couple of days, but let's keep this in perspective. We're coming off all-time highs. And yes, these routes, when they are 2 or 3 percentage points in a day, certainly feel very bad. They provide a lot of angst for investors. We feel like we have to do something. But this is kind of the nature of the markets as of late. These, if you go back to January and the early part of February, we had a very similar 10% sell-off just over the course of a few days. The markets then rallied back very almost to where they were at the peak of January, got everybody very confident, and we went right back down to where the lows were. So it's very likely we're going to see a lot of that same action here over the course of the next few days. That rally, whatever that rally turns out to be, is going to be an opportunity to reduce risk in a portfolio, to take some money off the table, rebalance the risk. If the last couple of days have really got you under a lot of pressure, a lot of stress because of the sell-off, it means you have too much risk in your portfolio. So this will be a good opportunity to rebalance, because going forward, this is what we're going to be talking about today. Was today's sell-off and yesterday's sell-off, is this correction just a correction, or is it a signal that the markets have now changed their tone? So, Mike, what say you right off the bat? What do you think?
Again, I want to see if we can get below where we were in January and February. And if we do set lower lows, that tells me this has a higher probability of being a topping process versus a consolidation within a larger bullish uptrend.
Well, one thing was different here. I was going back and doing some looking at the sell-off in February, and the one thing that we didn't do that we did today was break the 200-day moving average. And today, not only did we break, over the last 2 days, we broke the 50-day, the 75-day, the 100-day, and the 200-day. There's been no support for this market on this sell-off, and we've lost 1,300 points in the Dow in 2 days. The difference this time that really has me paying much more attention to this is the fact that we broke the 200-day. Now, historically, the 200-day is over the last few years anyway, it has almost been a buying opportunity. Investors have looked at this as like, oh, you break the 200-day, you buy it, you buy the dip. The question is now, this is a pretty severe break of the 200-day moving average. Has that tone of investors changed from buy the dip to sell the rallies?
Lance, I would add to that one of the biggest buyers out there has been corporations buying back their own stock. And because this sell-off occurred as earnings are getting ready to be released, corporations are on blackouts and they're not allowed to buy back their own stock. Mm-hmm. So one of those buyers that does buy at significant moving averages is absent right now, and will continue to be absent for another week, 2 weeks, even 3 weeks to some degree.
So I think that brings up a good point here, is that part of this entire run-up that we've seen in the market has been from the fact that we've had exceptionally low interest rates. A lot of these buybacks have been funded by ultra low debt. We saw a lot of stock buybacks earlier this year because of repatriation of foreign dollars because of the tax cuts. And there is a point to where corporations have bought back a majority of the shares that they're going to buy back. And how long can that stimulus of buybacks really kind of continue to be supportive of the market?
Right. They've also used debt to buy back stock, and a lot of these companies have seen their credit ratings deteriorate. Mm-hmm. And the number of the percentage of triple B companies as a percentage of investment grade is higher than ever, which means that as a percentage of triple B, which means that they're on the precipice of potentially being downgraded into junk. So the question is also how much more can they borrow, and at higher interest rates, that becomes a bigger problem. So You're right. We may be seeing the end of the buyback cycle.
Well, and that's particularly the case where, with interest rates rising, even if I'm a corporation and I'm, even if I'm positive, flush-wise, if my balance sheet is good, revenues are good, there is a point to where I start looking at the cost of borrowing money to buy back debt versus the inherent benefit that I'm getting. And with interest rates rising, the question then becomes just how much demand is there for dollars at higher rates for doing stock buybacks? Because, the one thing we're not seeing is a lot of money being borrowed to go into capital expenditures. We're not seeing a lot of money going into wage growth. We are seeing some modest increases, but not to the degree that you would have expected from having 2.5% interest rates this long.
That's right.
So here's the big question. The question that's on everybody's mind right now. Obviously, you kind of look across sectors. There's really not been a safe place to hide. This is one thing we wrote about in today's Technically Speaking update. There is going to be a bounce here. One thing as investors is that we tend to always do everything backwards. We presume that since the stock market is going up, it's only going to go up. And then when it goes down, we immediately presume it's only going to go down. The issue is that we're going to get a rally. And the important thing here is to use that rally to reduce risk and change dynamics in portfolios, because this sell-off, to me, feels different than what we've seen previously. There's been a sharp rise in rates here recently. That impacts the economy. We're seeing a slowdown in housing, and these things are all different than what we saw at the beginning of this year. When we had the sell at the beginning of this year, really economic data was great. Earnings were exploding because of tax cuts. We had a huge surge in earnings. What are we seeing now? We're seeing housing prices really under a lot of pressure. We're seeing mortgage applications under pressure. We're seeing auto sales under pressure. These are very consumer-related issues to the economy and suggest that these higher rates are starting to impact economic growth. And we just saw corporations issue the most number of negative revisions on earnings since 2016, which suggests that maybe there's some risk to earnings season, which could put more pressure on the market.
Yeah, I would say another catalyst is the Federal Reserve. They appear to be unwavering, at least so far, and they want to continue to raise rates. I'm sure we'll talk more with Danielle about that. Mm-hmm. But in the past, with Yellen, Bernanke, Greenspan, they have had a quick trigger finger. And investors have felt very comfortable knowing that what was originally called the Greenspan put, then became the Bernanke and Yellen put, was in place and would protect them. And I don't think there's that much confidence that Powell will protect them as equally as much as his predecessors.
So, and again, that's a really good point. I'll tell you what, let's do this. Let's take a break. And when we come back here in a second, we'll have Danielle DiMartino-Booth on the line, the author of the Daily Feather, president of MoneyStrong, because I want to ask her about, the Federal Reserve and Jerome Powell. She's a big fan of Jerome Powell. But Donald Trump says the Fed's just gone crazy. We'll be back with Danielle and more of Michael Lebowitz right here on the Lance Roberts Show. You get the Lance Roberts Show podcast here every day right at realinvestmentadvice.com. We'll be right back.
Catch Lance Roberts' podcast later at lancerobertsshow.com.
For the best proprietary stock and ETF analysis by Lance Roberts, subscribe now to the new professional version of Real Investment Advice, RIA Pro. You'll get the expanded newsletter and critical investment information you need with the professional version of Real Investment Advice, RIA Pro. Subscribe now at realinvestmentadvice.com and click on the RIA Pro tab. The Pro site is now operational. Subscribe now at realinvestmentadvice.com and click on the RIA Pro tab. RIA Pro.
Lance Roberts is back Saturday mornings at 9 on AM 700.
Investors have a very, very short-term memory of these issues, and I like wearing Nike shoes.
Lance Roberts is back Saturday mornings at 9 on AM 700, the voice of Texas.
And welcome back to the Lance Roberts Show. I'm your host, Lance Roberts. It's the Lance Roberts Podcast right here at realinvestmentadvice.com. Michael Lebowitz, CFA, online with me. We're going to be getting Danielle DiMartino-Booth here on in a few minutes. We're just trying to get her all connected up here. But before we get to that, I thought it was interesting that, two things. One, we have a Federal Reserve that came out just recently. And of course, let's backtrack. Let's set the stage for everyone. And I'm actually writing an article for this on Monday talking about QE and quantitative easing and what the Fed's been doing in terms of lowering interest rates, flooding the system with liquidity. And it's not just been the ECB, not just the U.S. and the Federal Reserve. It's been the ECB. It's been Bank of Japan, Bank of China. I mean, this has been a worldwide liquidity flush into economies to boost asset prices. The hope is that by creating this wealth effect through higher asset prices, that would trickle down into the rest of the economy. But really what we've seen is a very big shift in wealth from, the 80% of the world's, average person to the top 10, 15% of the economy. The top 1% of the economy owns more wealth than the other 50% combined. So, it's pretty incredible how much money is pinned up at the top versus the bottom. And not surprisingly, we haven't seen real strong rates of economic growth. Should we expect to see that change in your opinion? What do you think, Mike?
No, I mean, I think, like you're saying, it's so much of the growth has been based on speculation and not long-term investment, capital expenditure. And yes, you're going to see some growth, and we have seen growth. But if you're not ultimately building into production and means of production and efficiency and innovation, you're not helping long-term economic growth. Instead, you're just racking up a bill that has to be paid at some point. So, yeah, you can buy a few more quarters here and there, but all the while you're just building up a bigger and bigger debt and not building up the means to pay for that debt. And that's the problem with the policy for the last at least 10 years, but I would say much longer.
Well, I thought Wolf Richter, who writes for Wolf Street, had a very interesting point today talking about QE. And the question was twofold. One, why hasn't QE created all the inflation that people thought it was going to do? Remember back in 2009, everybody said, QE is going to create this massive runaway inflation. We're going to have the 1970s inflation all over again. That never really occurred. And the second point that was asked was, well, can the Fed come back in and do QE again? And I thought that was an interesting question because this seems to be the real premise here, is that markets can only go up from here because we can never have a correction again, because the belief is that the Fed will just simply come back in with more QE. And now that we've trained investors, kind of like Pavlov's dogs, that every time the Fed shows up to do QE, well, that means buy asset prices. But the question really becomes the efficacy of just how much they can do with their balance sheet no longer at $500 billion where they started, but still close to $4 trillion today.
And when do they start taking too much control of the markets? Mm-hmm. Like we're seeing in Japan, where they own, 80-90% of all Japanese ETFs. I mean, they have essentially taken over part of the stock market and almost all of the bond market. How much is the Fed willing to do that, and at what cost?
And that's an interesting point, because when you take a look at Japan, and I've got a chart on this that we'll be posting out on Monday, despite the fact that their balance sheet, which, their QE program and Bank of Japan, so Japan's about 1/3 the size of the United States population-wise. They've done a QE almost twice as much as the United States has, and yet they're generating about a 1% growth rate economically. Yes, currently right now, we're having a very nice growth rate. We've got nominal growth around 5.2%. Real GDP growth is running around 3%. That's after inflation, obviously. But a lot of that U.S. growth, and again, we've got a higher growth rate than most every other country in the world, which you have to step back and go, well, how can the U.S. have such a high growth rate when the rest of the world doesn't? Well, we've been the beneficiary of, 3 massive hurricanes, 2 major wildfires late last year, of course, tax cuts, a massive amount of deficit spending. What kind of went under the radar was at the beginning of this year when we passed the Tax Cut and Reform Bill. Nobody paid attention to the Budget Bill Control Act that was passed in January of this year, which basically unleashed the government to spend as much money as they wanted. There was no cap on spending, and we're running nearly $1 trillion deficit. And this is an important point to understand, is that we're running, the last time that this country ran $1 trillion deficit was in the middle of the financial crisis. We're supposed to be in the middle of one of the greatest economic booms this country has ever seen because we have 3.7% unemployment, and yet we're running $1 trillion deficit. Something doesn't quite jive with that picture.
There's a massive, I think what you're really trying to say is this economy and these markets are being pumped up by a massive amount of stimulus, whether it's fiscal, monetary, or global from other central banks. And there doesn't seem to be an appreciation for that, the market seems to believe that that the run up in a market and the decent economic growth is based on its own merits, on its organic growth. And that is very far from the truth. It's a very fake economy. We have Halloween coming up, and that's what it is. It's a costume. It's a mask. And just like November 1st always comes, so will when we take the mask off this economy.
Well, by the way, you do know that Halloween is one of the biggest shopping seasons of the year. I had no idea about this, but as far as holidays go, it's like right up there with Christmas. Everybody's buying decorations and costumes and, candy sales. Great time of the year for that. My wife supports this year very much, this time of year. So,
mine as well.
I know. But here's the point. Okay, so here I am. I'm an investor. I'm trying to figure out what's going on here. I've got money invested in the markets, and the question is, and particularly when you look at the market, where's the damage coming in? And the damage is really coming in from the areas of the market that have previously been the leaders, right? Your FANG stocks, the Facebooks, the Apples, the Amazons. Amazon has been absolutely crushed over the last few days. And if you take a look at the stock, what's really changed? Have the fundamentals changed? Have the outlook for the company changed? Have their earnings really had a significant change? Why is Amazon in particular being taken to such a large degree of task in this sell-off? And I think this goes right to the heart of what you and I have written about numerous times, which is this liquidity issue that's been created by all these passive indexes. And we've talked about the risk that when the selling starts and people begin to sell the stock of Amazon, all these ETFs that own Amazon as a consequence of that, when those ETFs start getting liquidated, you get a compounded effect of the sell-off of that individual stock. And that's really the only explanation you can have here, is that what we're seeing over the last couple of days is a very early hint of what a liquidation crisis is going to look like if we ever do get into a major sell-off.
Right, I agree. But you also have to ask, why was Amazon going up every day when its business hadn't changed? And, you're seeing the exact opposite. When liquidity is flowing, everything just goes up and up, and we've seen that for months and years. But when you take away liquidity just a little bit, you can see that it's the old saying, the stairs up and the elevator down. Yesterday, what did we do? We wiped out 2 to 3 months of gains in a day.
Right.
And so liquidity is something to be pay close attention to.
Well, and another thing too is that we've talked about over the last few days in particular is that interest rates, or bonds rather, interest rates have been going up. Of course, when interest rates rise, bond prices go down. And so one of the problems yesterday is that not only did you have a sell-off in the stock market, but you've also had this, pretty hard sell-off in underlying fixed income. Today, though, we saw a reversal of that. which is what you would expect, is that you would see money coming out of equity risk into the safety of treasuries. And, we saw that rotation kind of start today. Treasuries were up about 9 bips today, and we saw yields drop to about 3.13%. And that's kind of what we've been expecting to happen.
Right. We also saw gold do very well today, and we saw even Fed funds are starting to price out the fact that the implication that the Fed will raise rates in December. Now, it's still a very high likelihood, but not as high a likelihood as it was 2 days ago. Mm-hmm. So the market, at least the fixed income market and the gold market, I think are trying to say that the Fed may back off, which is a negative for the dollar. But again, we have to wait to see if the stock market buys into that reasoning.
We'll find out. And we're going to take a quick break. We're going to come back. We have the lovely Danielle DiMartino-Booth on the line with us. And we're going to talk specifically about the Fed. We're going to talk about Powell. We're going to talk about Donald Trump calling him batshit crazy the other day. That's all coming up with Danielle DiMartino-Booth. She's the president of MoneyStrong. She is also the editor and writer of the Daily Feather. We'll be right back after the break, right here on the Lance Roberts Podcast.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at LanceRobertsShow.com. Lance Roberts is back Saturday mornings at 9 on AM 700.
Investors have a very, very short-term memory of these issues, and I like wearing Nike shoes.
Lance Roberts is back Saturday mornings at 9 on AM 700, the voice of Texas.
And welcome back to the show. I'm your host, Lance Roberts. Michael Lebowitz, CFA, and on the line with us right now, the lovely, the one, the only Danielle DiMartino-Booth. I don't know where she's been lately, but she's been all over the place. Danielle, how are you?
I'm doing great. How are you, Lance? Good to talk to you. Hey, Michael.
I don't know. Mike's going to sit over here, and he's just going to kind of listen in here for a few minutes because he's up in Maryland today, and he's just kind of taking it easy. I did want to talk to you specifically about Jerome Powell and the Fed, because what's happening here in particular, I thought was interesting yesterday. We've got this market selling off. As Mike and I were just talking about a second ago, it looks like the market's trying to start to maybe price out some of the potential rate hikes that were kind of expected to come in from Powell. And of course, yesterday you've got Trump basically calling Powell crazy. What the Fed's doing is just crazy here. But I do find one thing very interesting. If you listen to what companies are saying, I don't see one company coming out and announce. We've had the most negative earnings announcements since 2016, but yet not one of them are saying, man, we're really worried about rate hikes and interest rates going up. No, their number one concern is the impact of tariffs. So if anybody should be concerned about who's doing what that's crazy, it would actually be Trump's tariff war. Do you disagree with that?
Well, I think that this is, I heard a talking head yesterday say that this was a fantastic opportunity for Trump to march back his trade war rhetoric. And I found that to be interesting. It's all about containing the damage control. I think that people should be paying attention to what true inflationary signals are. You had some bellwether type stocks, Fastenal, for example, came out and reported that their margins are getting hurt because their input costs are rising, and we know labor costs are rising. People don't want to hear that wage inflation is taking off because that is truly a trigger for the Fed. But there's no disputing what the Duke University CFO survey produced last week, and that is that the people who set budgets for compensation anticipate that over the next 12 months, the compensation costs will rise by 4.8%. That is a big number. And if that is the case, because there's this grab for warm bodies as opposed to being able to pull unskilled workers off the sidelines, that's going to keep Jay Powell engaged.
Well, so Mike, what Danielle's suggesting here is that that what companies are saying is there's going to be a very strong spike in wage growth over the course of the next several quarters. And of course, this has been the belief for a while. And yes, nominal wages are rising, but we really haven't seen real wages rise at a degree that has really compensated for the last really 2 decades of no wage growth whatsoever. I guess, Mike, from your opinion, I mean, do we see this wage growth, particularly when you look at factors like the labor force participation rate still remains very mired at multi-decade lows? We are seeing job growth, but unfortunately, we're not seeing job growth in some of the areas that are higher wage-paying sectors. It was interesting. Amazon talked about wage hikes yesterday. They're going to increase wages to $15. And then they said, well, we're also going to give you a bonus. So if you work for us for 10 years, if you work for Amazon for a decade at $15 an hour, they're going to give you a $1,000 bonus. If you get there for 20 years, you're going to get $1,500, and you're going to get a whopping $3,000 if you can stay at Amazon for 30 years at $15 an hour. That really doesn't seem like much of a wage increase to me.
God, boy, Lance.
It definitely feels like employers still have pricing power. They're even Amazon seems to be. Yes, they're raising their minimum wage, but they're also taking away stock options and other things. That tells me they have a lot of power. They have leverage. And I know the unemployment rate is incredibly low, but like you said, the participation rate is also very low. So I think, yes, the potential for wage pressure is there, but we haven't hit that precipice yet where it really starts rising to be of great concern. But that said, I do understand why the Fed is watching it carefully and showing some concern over it, because I think it can happen quickly if we keep seeing unemployment continuing to drop.
Yeah. So Danielle, and then I guess that's really the question here too. And again, Trump coming out yesterday saying the Fed's crazy for hiking rates. Of course, Donald Trump has pegged a lot of his presidency. And look, you and Danielle, you and I had this conversation very early on, right after Trump had become president. You and I had this conversation that, he was pegging a lot of his success on the back of a financial market, on the S&P rising. And that's a double-edged sword. And of course, now that it's not really cooperating with him and we're about to go into midterm elections, this may be kind of coming home to roost. So the question is, will Jerome Powell kind of give in to the pressure from the White House, or do you think he's going to maintain his independence?
I think that we have the best chance since Paul Volcker, and before Paul Volcker, William McChesney Martin, who was famous for saying it's the Fed's job to take away the punch bowl just as the party's getting started. I think we have the best chance that we have had in generations, plural, Lance, for Jay Powell to stand his ground and not be swayed by political influence. People do not appreciate his resume. This is a man who worked for a $1 salary to educate the Congress on the perils of the United States defaulting on its debts. He does not need the job at the Fed. He is serving at the Fed. And I think he is approaching the job, and I hope and pray, with nobility. I was not impressed with his most recent speech. I was distressed that he sounded like an academic. I have to put that out there. But I think that he will grace the Fed with the independence that it has been lacking for three solid Fed chairs: Alan Greenspan, Ben Bernanke, Janet Yellen.
Well, and that really kind of brings me to an article that you just wrote recently called "The U.S. Economy is on an Artificial Tariff-Driven Panic Buying Sugar High." But it is interesting because we saw this, at the beginning of this year, and this is where, what I was addressing a little bit earlier, that things seem to may have changed here. At the beginning of this year, we had a similar correction to what we're seeing right now. Markets were down 10% in a very short period of time. But at that time, we had just gotten the tax cut, so we had this huge boost to bottom line earnings. We had the government pass a bill that basically uncapped spending, and so we've seen the deficit explode towards $1 trillion. And when I was just talking with Mike about this just before you came on with us, is that we're running $1 trillion deficit, which the last time we did that was in the middle of the financial crisis, not in the middle of this extraordinary economic boom of 3.7% unemployment, GDP growth at 5.2%, et cetera. Something doesn't quite jive here with this rally in the market, with where interest rates are, and with what's happening in the markets currently. And the message to me suggests that, here we are moving the last part of this year. We're already getting some economic warnings coming from different areas. We're seeing housing prices really come under pressure, housing sales, auto sales under a tremendous amount of pressure. It looks like a very early kind of warning sign that this economy may have just kind of hit its tipping point with interest rates at 3.25%. Your thoughts?
It is entirely conceivable. If there's one thing that makes me want to throw my shoe at my TV, it's when somebody comes traipsing out and saying, well, when I was a young nipper-snapper, my mortgage was 16% in 1981, and I was doing just fine. These people don't understand how very low mortgage rates. And I'm like, dude, it's all about the delta. It is all about the difference. People took out mortgages for 3.5% a few years ago. 5-year ARMs are going to be resetting at 5.5%. That is a huge differential. That 2 percentage point differential is huge. We know already that the average monthly payment in this country this year is up 18%. That is a real number, even as we've begun to see, as you've just said, home prices come off their high boil. It's all attributable to the rise in interest rates. Starting points matter.
Yeah. Oh, and it's absolutely true. And again, I absolutely agree with you, because Mikey's one of those old guys that had like a 16% mortgage, back in the day. But I remember that too. But the difference is that when my parents had that 16% mortgage, they had no credit card debt. They paid in cash for everything. Yes, they had a checkbook and a banking account, but they didn't believe in debt. They didn't use debt. The average debt to household net worth was about 60%, not 150% that it is today. And again, look, Mike knows the stats. You know the stats. I know the stats. Just the other day, Fidelity came out. Average 401k balance for the bottom 90% of participants. The bottom 90%, $26,000. They can't come up with $500 for an emergency. How are you going to absorb a doubling of your interest payments when rates rise? And you're absolutely right. It's the delta. It's not what it used to be 20 years ago. It's what was it last year, and what is it this year?
Exactly. People need to understand that, and I understand that Jay Powell is I know that he wants to get to that 3% neutral rate, but that is 4 rate hikes into the future. And if there's one story that has been underappreciated today, in fact, I unmuted my CNBC. I listened to Rick Santelli earlier today when he was talking.
Well, he's the only one worth listening to.
Well, good point. But it is the fact that we've started to see a reflattening of the yield curve. And those are the things that I'll be paying attention to going forward, because, again, I think that we have a shorter runway than we had in prior cycles. People are always like, well, from the time that the yield curve inverted in 2005, the 2-year rate being above the 10-year rate, from that time we had 24 solid months of expansion in front of us before we actually entered recession. I'm sure it's going to be identical this time, to which I always reply, look back instead to 1999 when the yield curve first inverted and we had all 13 months of runway in front of us because of how egregiously overvalued the stock market was at the time. But now we have the quote-unquote everything bubble. Everything's overvalued. So I would foresee that we would have an even shorter runway than 13 months between the point of inversion and the U.S. economy hitting a recession.
Well, and the one thing that and yes, I absolutely agree with you. And the one thing that always gets me, and again, if I wore a high heel shoe like as well as you do, I would throw it at the television too, because you hear this quite often, which is that, well, the average time between an inversion and a recession has been, 18 months, 24 months, pick a number. The difference is that every previous point in history, when we went to an inversion, the economy was running at 4-5% GDP growth, not 2.5. So in other words, to go from economic growth to recession, you need 2 quarters of negative economic growth. It's a far different story to go from 4% economic growth to negative versus 2% to negative, right? So you have half the distance to go to get to negative, which means your time frame to recession is just logically going to be shorter. And then you throw in the points that you just made about valuations and the other issues, and that time frame could be a whole lot shorter than people currently expect.
Look, go back to the sugar high. I mean, you're talking about the whole idea of compression and time compression. If you go back to the sugar high and the fact that the supply chain and people are panic buying and they're trying to get out in front of the tariffs being potentially risen to 25% on the Chinese goods, come New Year's Eve. Go back to that. If none of this comes to fruition, look at the height of the cliff going into the first quarter, Lance. Think about that. And the first quarter, for whatever reason, the statisticians in Washington, D.C. have not been able to figure out how to seasonally adjust the first quarter. So for the past few years, it has tended to be weak as it is. So can you imagine the double whammy of the full sugar high coming off, the inventory rebuild being completed, and look out below come Q1? All I'm saying is, I'm not saying recession's right around the corner, but I'm saying that the dominoes are lined up from what we can see to cause that to happen. You know, people didn't even notice that used car prices crashed in this morning's Consumer Price Index report. One of the smartest auto analysts on the street, I read, he's like, this is it. Consumers have hit their pain threshold. They can no longer afford to buy these things. If you have autos and housing both turn, they are your leading economic sectors that always lead the economy into recession, and people are not paying close enough attention to them.
Well, absolutely. Well, and of course, we never do because, again, you know, you listen to most analysts, they're predicting, well, we won't have a recession until 2020. But again, you've got early leading indicators that are suggesting that this economy is already beginning to slow down. Consumers are under pressure on a lot of different fronts. And couple what you're talking about, rising interest payments. Wage growth has gone up, but not nearly enough to keep up with the rate of inflation. Plus, you have oil prices back up around $70 a barrel, which means higher gas prices at the pump, which means an additional tax on consumers as well. So when you start talking about all these different impacts, and of course, the stronger dollar has been an impact on corporate profits. Exports for corporations make up about 40% of corporate profits. So pretty much all around the fringe, we're seeing everybody being hit by some form of quote-unquote tax that erodes the ability to consume elsewhere. And it's not surprising we're beginning to see the early signs, at least, of economic issues. So, Mike, I want to throw this to you real quick because Danielle just brought up, was talking about this great point about what's happening in terms of the economy. She mentioned the fact that we've had this sugar high because of tariffs in the second and third quarter of this year. We saw some great economic numbers, and we know for a fact that a lot of that was attributable to companies going out and buying, soybeans and a whole variety of things to try to get in front of these tariffs. But also, too, we all kind of forget that last year we had these 3 major hurricanes. We had these 2 major wildfires out in California. Billions of dollars. I mean, here in Houston, we're still recovering from a lot of those issues from Hurricane Harvey, but billions of dollars went into the economy, into the very areas that we saw get a boost from, manufacturing and employment and the construction fields, et cetera, all saw a big tick up. And that was due to those natural disasters and all that spending. Combine that with the tariff issue, and I think Danielle's right on point here that we've had this very short-term sugar high, but the other side of this is going to be that sugar crash at the same time.
I agree 100%. None of that spending, or very little of that spending, was productive, meaning that it's not going to pay back in the future. And that's, you're buying growth and you're buying it for a year or two, but it's not lasting growth. It's not resulting in meaningful wage increases, more production, all the things that can boost an economy over time, that can durably boost an economy. So sugar high is the perfect way to say it. It's going to last, but when we come down, it's going to be hard and it's going to be quick.
So Danielle, go ahead.
Sorry, I was just going to throw in there the other elephant in the room is that on October the 1st, we went net negative on global quantitative easing for the first time in, a decade. And we're at our maximum run rate at the Fed with the shrinking of the balance sheet, with quantitative tightening. And the only thing that was holding this market together was the superglue of record share buybacks that was also a result of yet another cube of sugar, and that is the repatriation that supercharged share buybacks, pushing them from about $550 billion to about $850 billion this year. There's absolutely no mystery as to why the rest of the world's stock markets are tanking. It's because they didn't have this tax plan. They didn't have the ability to jack up their share buybacks. The only thing they've been on the receiving end of is this huge decline we've seen in quantitative easing and liquidity pouring into world markets.
Well, so Danielle, let's so we're painting a doom and gloom picture here, right? I mean, and that's pretty much what this turns out to be. Is that and I don't want people to just go, oh my gosh, the world's about to end and
The world's
and all
ending.
yeah, we don't want to say that at all. But I do think all this is important from the standpoint that as investors, we need to understand what the risks are. And no matter where you look in terms of the mainstream media, it's this continued, and even today, after the bell, the market's down, they're 2% change today. And the guys are on CNBC and everybody else is saying, oh, just buy the dip. It's all going to be fine. Look, everything's terrific. We're just going to go up from here. But markets don't always work that way. And again, as I was saying before, is that no matter kind of where you look, if you look, it's kind of like Halloween, right? And we're to that point to where as long as you don't look behind the mask, everything seems to be okay at this point. But once you start to peek around the corners, all of a sudden you're starting to see the real problems that have historically denoted bigger change in both economies and markets. And, so I think people need to be aware of that. And I think you agree with that. But it also doesn't mean it's going to happen tomorrow.
No, and again, there is really wage inflation in this country. There really is, and it really is. If you look at the University of Michigan, they put out their confidence survey once a month, and they parse it out by incomes. That the top third of income earners, the middle third, and the bottom third. Well, the top third confidence it turned towards the end of last year. People know if they make a lot of money, they can sort of get a sense of what is coming down the pipeline. But then you had 18 states and 20 cities implement higher minimum wages, and you've had this grab for labor because of all this confluence of factors, the $300 billion in insurance proceeds, and the need to rebuild after 2017's natural disasters, the weaker dollar that juiced up manufacturing last year, that put the supply chains in a pickle, and then the trades and the tariffs and the tax cuts on top of all that. But that it's this bottom 30% that has been this main beneficiary of wage increases. They don't own stocks. They're not in the stock market. They don't have 401ks. All they know right now is that they have a slightly larger paycheck and that the family is going to Applebee's for dinner. And that is real economic activity, and it's going to take some time for that to turn.
Yeah, absolutely. All right. Well, let's talk a little bit about let's bring this home and wrap this up, Danielle. We got Jerome Powell. He's slated to hike rates towards the end of this year. 3 to 4 more hikes next year. How far do you think he gets?
It's interesting. I've been a lonely voice in the wilderness saying that if he really is intent on raising rates and trying to get out in front of a recession, he might even go in January, right? It's a January 29th, January 30th meeting because he's implemented press conferences after every FOMC meeting, which makes all of them live. But I cannot see, given the economic tea leaves, unless there's some kind of monumental infrastructure spending plan out of Congress, a couple $1 trillion, throw at the economy. I just don't see what the catalyst is going to be to push this economy past the beginning of the year and justify going out and having 3 or 4 more rate hikes in 2019. I can't see it. I can see him trying to get off 1 or 2 more here.
Right. Well, and I think we need to be clear about this, is that, and this is my opinion anyway, and we'll take a poll here and we'll see who agrees with me. But my opinion is that I think Jerome Powell understands that we are closer to the next recession than not. And I think he understands that we only have a limited time to get off of zero to some level to where he has a tool available. And the one tool he knows that will work to some degree to not solve a recession, but to maybe limit a recession to some degree, is the ability to lower rates. I think he understands that quantitative easing has some effect, but where they are now, he's got limited efficacy with that program. So I think he understands, and I think he knows that the only tool he really has to any degree to operate has got to be interest rates. And he's got to get that to some level as high as possible. And I think he's even willing to push this thing until something breaks to have as much room as possible. Do you disagree?
I do, and I, if you read the 2012 transcripts, he was very skeptical about quantitative easing and its efficacy. I don't think he's a big proponent of blowing up the balance sheet right away. So I do think that he wants that conventional tool of interest rates, as many arrows in his quiver as he can possibly get. He really, really, really wants that 3% neutral rate.
And that's what I'm saying.
He wants to have that ability.
So you and I don't disagree. I mean, you're saying that he's willing to try to hike this to 3%, even if the economy is showing signs of cracking. You don't think he's going to back off until he gets there?
My greatest concern is that because he's having to correct for his predecessors, right? Janet Yellen, under her reign, had the slowest pace of monetary tightening in the history of the Fed.
Yep.
So he's having to make up for her being as reluctant as she was, and try and get the rate up to 3%. Usually it's 4.5%, 5%. Usually there's a lot more runway when we hit recession. There's a lot more in terms of how much we can lower interest rates at the time of recession. I think that getting to only 2.5% scares the daylights out of Jay Powell, because it doesn't give him much ammunition to fight the next war.
Yeah. See, and like I said, Mike, Danielle just disagrees with me because she just wants to disagree with me. She's like my wife, right? So
I am a female.
I know. And you just you've always, every time we've done an interview, you disagree with me just to disagree with me. And it's completely okay. And I love it. Mike, what's your opinion on this? Do you agree with Danielle's assessment?
I think I agree more with you, Lance. I think he's going to keep raising. The last 6 recessions, they've brought Fed funds down at least 5% each time. Right now, Fed funds are, 2.25%? They have no room to lower rates to try to stimulate the economy. The other part of it is that Powell has not spoken well of QE. He understands that it boosts asset prices, boosts speculation, but doesn't have a great effect on the economy. So I don't think he really wants to use QE. Therefore, if Fed funds are his only tool, he's got to get them higher so he can lower them, as crazy as that sounds.
Yeah, well, and that's really kind of what so basically we all agree to some degree. And Danielle, I think that's a good point. What other, we've talked about other methods by the QE in the past, other methods by the Fed in the past to try to stimulate, economic growth and support the economy, outside of just lowering rates. And if, and you and Mike are both agreeing that he's not a big fan of QE, where do you think he's going to go outside of just manipulating rates?
Well, then you've got a real problem on your hands, don't you? Because the toolbox is pretty depleted. And to me, at least, that defines the, I don't want to use a big word here. I'm not trying to be alarmist. I'm just reporting what I see with my own eyes.
Sure.
But, one of, I think, the most reckless things was the tax reform, simply because the Fed does not have adequate tools to fight the next recession. QE is not the solution. He's already said that negative interest rates are not someplace that he would go. He recently said that. And that means that the onus goes back to Congress to implement some kind of fiscal stimulus. And what do we have there?
Well,
because we've already spent so much.
Well, and then
so I wish we would have saved up that fiscal stimulus for when we really needed it.
Well, I wish you would have been here on the show when I was arguing and railing against Congress for actually doing that back earlier this year for the exact same reason, which is you don't do a tax-based stimulus or a fiscal stimulus when the economy is booming. You need to save that for when the economy needs it. And to your point, they've the ability for them after the midterm election, if we lose the House or the Senate, if one of those two get lost in this midterm election, and there is a very high probability that could well occur, particularly in the Senate where you have a very small majority. Any ability to pass fiscal stimulus or any other type of program, just because Trump wants to do it, is basically going to be dead on arrival. So this really leaves Jerome Powell kind of on an island by himself. As Chuck Grassley was famous for once saying to Ben Bernanke, "You're the only game in town," and that may very well turn out to be what Powell is in the next crisis.
Yes, but look at, as you just described, a Jerome Powell with no ammunition.
Right. The only game in town with no game.
Yeah, exactly. And you are right. If we have gridlock, to me, the travesty of Congress is that both parties agreed that the country was crumbling. Both parties agreed that infrastructure was the way to go. It would have created jobs, and yet they chose not to go there. And even if the House flips come midterms, for the sake of not getting anything done, they won't pass an infrastructure bill. I mean, that's the kind of a divided country that we live in.
Yeah, there was a recent study out just showing the division between the right and the left, which is now at the greatest level ever in the history of the United States. Danielle, thank you so much for your time today. Have you back here soon. Let's, especially after the next Fed meeting, it's probably a good time for us to hook back up and talk about where this conversation winds up by the end of this year. Appreciate you always, my friend, and we'll get you this podcast as well for your site.
Fantastic. Look forward to it. Thanks. Good night, Michael. Enjoy D.C.
There you go. All right. And Michael Lebowitz, thank you so much for your time today. Appreciate you as always. And we'll have you back on Monday's edition of the Lance Roberts podcast right here on realinvestmentadvice.com. Get by our website, as always. Get this podcast and more. Subscribe to our YouTube channel. And, of course, you'll get alerted for all of our podcasts right there at lancerobertsshow.com. Also, go by our website, realinvestmentadvice.com, and click up with our latest blog posts, articles by myself, Michael, and everybody else on our team. It's all at the website, realinvestmentadvice.com. And check out our new pro version of our website, RA Pro. It's up now, lancerobertsshow.com, realinvestmentadvice.com. It's all there for you. We'll see you next time.